Guys, welcome back to my channel. So today we are going to do an exclusive video for Humber students. So we are going to talk about some mortgage and financial terms that you really want to know going into your new role of becoming a licensed realtor. So today I have a special guest, Charles, and he's going to give us a good idea of what things to look out for.
Guys, my name is Charles. I'm a mortgage and lending specialist for mortgage architects, and I cover everything from residential to commercial financing.
Okay, so we're gonna go over about 8 terms that you'll see within the courses and that you guys just wanna have a good understanding so that when you are in the role of being a licensed realtor, we always refer out to third-party specialists like Charles for people to handle the mortgages and things like that. But just to be able to provide a better service for our clients, we want to have a good understanding of how the whole financial piece works. So coming into the industry, even with you guys being in your courses now, it's a really good idea to start networking from now. Find out what mortgage broker you want to work with that has great customer service and can get results for your clients. So that's one of the reasons why I got in touch with Charles, and he's a really good connection. So feel free to reach out to him if you have any questions or if you want to run over some numbers with him and you have a client who's looking to get a pre-approval. He's really good. He actually can get a pre-approval, give good rough numbers in a phone call under 30 minutes. So any questions you have, definitely check him out. So for the first term, can you describe what is a first mortgage? And it's going to kind of go into the next question, which is what is a second mortgage? But if you can go over that.
All right, perfect. So just to break it down into layman's terms, let's just take out first and just mortgage, right? Because that's essentially what it is. So a mortgage is just a loan that's attached to your property, all right? Now, the only reason why we call it first is because it's in first position. So let's say, for an example, you're a first-time home buyer, you put 5% down in terms of a down payment on that property. That means the bank is loaning you 95%, all right? Since that's the only loan that's attached to the property, said loan would be in first position. So if you were to default on the mortgage and you don't pay or anything like that, it's in first position, so it has first priority in terms of being paid off first.
Awesome. Okay, so now let's go on to what's a second mortgage.
So it will be pretty much the exact same thing. It's a loan attached to the value of the property, but now instead of first position, it's in second position. So again, if you were to default on the property, it's second on the list in terms of being paid off. So it takes second priority to the first mortgage. Now, any loans in second position generally come with inflated interest rates. That's the thing, because in the nature of the loan, it's a little bit riskier. So any lender, private lender that's going to take a second position, their interest rates are going to be increased because of, again, the inherent risk they're taking on. Now, just to give you guys a quick example, let's say you're purchasing a home for $500,000. You only have, it's a rental property, all right? So you have to put down 20% because that's what you qualify for, but you don't have 20%. Let's say you only have 10. The bank is only going to loan you up to 80%, right? In terms of a normal bank. And then you might have to go to a private lender, all right, to finance the rest of your down payment. So let's say you only have 10, the bank gives you 80, all right? But you're still missing another 10%, so you go to a private lender, they're going to loan you 10%. So the bank will always take first position because it's the bank, they're commercial lenders, right? That private lender will take second position at 10%. But they're going to hike up their interest rates because of the inherent risk. So that's so first position, second position.
I was just going to ask you, why would someone need a second mortgage? But that's a really good example.
That's pretty much it. No, finish.
Is that the same scenario if someone owns a home but is then buying an investment property or a second property? Would that second property be considered a second mortgage?
No, it would be considered a second mortgage, but not a second mortgage on that property.
Right. So
it's a different entity.
Okay.
Right, so it's a completely different home.
Okay, good. Okay, so what is refinancing?
Refinancing is when the bank allows you to remortgage your home up to the current value. Sorry, remortgage up to 80% of the current value of the home. All right. They're never going to allow you to do more than 80% because they want to keep that ratio in terms of they want you to have at least 20% equity in the home. So what I mean by that, let's say you bought a home at $250,000 in Hamilton 10 years ago, right? We have to be specific. We're not 10 years ago. Now that same home is, and let's say you have a remaining mortgage on it, $50,000, right? You've had it for 10 years, you paid it down. That same home is now worth $500,000, so it's doubled in price. The banks are only going to allow you to remortgage up to 80%. So that would mean 80% of 500 is 400,000. All right. So now you have a new loan of 400,000, which is going to pay off the old loan, and then the remainder comes to you in cash. Right now, you can use that extra money to invest in another property, pay off personal debts, maybe go on vacation. You can use that money wherever you want. All right. But that's essentially why people refinance their home. So you remortgage up to 80%, pay off the old loan, and the difference or the remainder comes back to you in cash. That way you can use it however you so please.
That's good. And that like equity cash that you're getting back, is that, do they only give it to you as cash, or can it be as like a line of credit?
Yeah, so they can give it to you. It's called a home equity line of credit. So it's that's the last question. But
yeah. Okay. Let's say that.
It's the same thing, to be honest with you.
Yeah.
I think because we're talking about it, it might as well, right?
Okay. Yeah.
So if you don't want to go through the process of refinancing, because refinancing takes at least, I would say right now in this climate, about 10 to 14 business days, all right, to do a complete refinancing, get the cash in hand. But some people don't like to refinance because you're getting a large sum of money in your bank account right away. So you pretty much...
Is that tax?
No.
Tax? Oh, okay.
Right? It's only tax when you sell your home because that's capital gains, right? So that comes in your bank account. Most people don't want to have like $200,000 in their bank account because they're just going to spend it all, right? Generally, you want to have an idea of what you want to use that money for. Or vice versa, if you don't want to go through all that and you want to get a home equity line of credit, it's the exact same principle. So they will allow you to remortgage your home up to 80%, but instead of going through all the paperwork, etc., all right, you'll just have to sign a document with your bank, and probably within a couple business days, they'll give you the equity you're allowed to take out, but in the form of a line of credit. That way you have a little more flexibility. That line of credit can sit there for as long as you want, and you don't have to pay any, you won't get charged on it or anything until you actually put a balance on it. And then that's pretty much it.
This is one that we'll deal with a lot as realtors, but what is a bridge mortgage?
My favorite. So a bridge mortgage is more or less an interim or short-term loan. All right, that allows the buyer to close on a property safely before they're actually able to sell their home. All right, so let's say, for example, you're trying to sell your home and you want to take the proceeds of that home to purchase another property. You found the property you want to purchase. All right, it's beautiful and it's closing in 5 days. All right, but you still can't find someone you're not able to sell the property. So what a bridge loan allows you to do is they're going to pretty much finance the down payment that allows you to close on the property, and then once you actually are able to successfully sell the property, it's going to pay off, all right, the bridge loan. All right. Now, to successfully pull this off, you have to have at least 20% of equity in the home you're trying to sell. Okay. All right. I guess just for a quick example, let's say the down payment on the new home is $100,000. All right. You're selling your home for $600,000, but you only have $300,000 that's owed. So there's enough equity in the home, right? Because they see, okay, perfect, you're gonna have more than enough to pay off the bridge loan, right? So they'll provide you the loan of $100,000. Again, it will be a little bit inflated in terms of interest rates, all right? Because it is a short-term loan, and the bank always wants to get paid. And then once you sell your property, you pay off that bridge loan, and then you can continue moving into the home you purchased.
And is it just banks that will do bridge mortgage, or private lenders as well?
Private lenders will do it, all right. But again, you probably want to go through a bank.
Better rates.
Better rates, exactly. Private lenders will finance pretty much anything. Right, but there'll be no advantageous to the client to go to a private lender. You want to get it done through the bank, especially if you have the equity in the home. Yeah, you're better off just going to the bank.
Okay, this is a good one. Everyone in course 3 will know about this. Can you explain what GDS means?
Okay. So GDS is your gross debt service ratios. So essentially, that's the carrying cost of the home. So I want you guys to remember this acronym, PITH. So that's principal plus interest, lands transfer tax, and heat. You're gonna add all those together, all right? And then you're gonna, irrelevant to your income, so whatever that percentage is, all right, that is your GDS, right? Now you wanna keep that below 39%. That's the maximum. So again, so that's principal and interest, land transfer taxes, plus heat, all right? Divide that by your annual income, the household annual income. So if you're buying with a significant other, all right? So both of your incomes together, because that's what you're qualifying for the mortgage. Multiply 100, whatever that percentage is, it needs to be below 39%.
Okay, so now let's go over what is TDS.
So TDS is pretty much the exact same thing. You're gonna take your GDS, what we just talked about, so your PITH, all right? But you're also gonna add in your personal debt and liabilities. So that's any lines of credits, credit cards, are you financing any cars? Or do you have any student loans? Whatever you're paying on a monthly basis, that's a personal debt, all right? You're gonna add that with the GDS, or your PITH, all of that divided by your income.
Okay, a little bit of technical issues, but we're back. Okay, so we're just gonna finish up talking about TDS scores.
Right. So I'm just gonna do a quick recap. So remember, TDS is the home carrying cost plus, all right, your personal debts all over your income times 100. That percentage cannot be more than 44%. All right. Now, so remember your principal and interest, land transfer tax, heat, plus now any personal debts you may have that you pay on a monthly basis. So that's like credit cards, lines of credits, if you're financing any vehicles, student loans, right, things of that nature. Add all those things together. Now you're going to divide that by your income times 100. That percentage cannot be more than 44% in order to qualify for one of the big commercial lenders like Scotia, TD, RBC, CIBC, etc.
Next point is, what is the amortization period?
Awesome. So the amortization period is how long you, the borrower, will take to pay your overall balance down to zero. All right. So 25-year amortization. So if you keep making those same payments over 25 years, all right, at that point, at the 25-year mark, your balance will be completely zero.
And do purchasers have the option to make that period shorter or longer?
Yeah, so it all depends if you qualify, right? But generally for a first-time home buyer, you cannot extend it. It has to be 25 years, all right? Just because first-time home buyers are generally putting, so I shouldn't say that. If you're putting less than 20% down,
Sorry.
no, it's all right. If you're putting less than 20% down, all right, now the government comes into place because you have an insured mortgage, all right? You cannot extend it past 25. It has to be 25. If you are putting 20% down, there's no government involvement. If you qualify, you can shorten it, but obviously that's going to increase your GDS, right? Because your month-to-month payments are going to be increased, right? So if you qualify, you can do that. And vice versa, you can also extend it to 30 years, which makes it easier to qualify because now your payments are stretched out over a longer period of time, making it a little bit cheaper for you to borrow, so more affordable.
Maybe can you just touch on what are some of the benefits of using a mortgage broker versus a traditional bank?
All right. So honestly, I would say we both do pretty much the same job. You go into a bank, they're going to ask you the same questions. How much do you make? What's your what's your credit score, what your personal liabilities, how much you have as a down payment, etc. Right? I'm gonna ask you the same question. The only difference is when you go to a bank, let's say Scotiabank, all right? Whatever mortgage specialist is working with you, they can only offer you what Scotiabank offers, all right? So whatever Scotiabank's best rate is for the product that you're looking to do, whether that be a rental property, a second home, a flip, etc., they can only give you what Scotiabank has to offer. If you are working with an independent mortgage specialist, we're going to take that same file, we're going to understand your needs, so similar to the bank, but I'm going to shop around your file at all the lending institutions that offer that product, right? And then from there, we kind of choose which one has the best rate on the market, or is the best for you on the market, because we work with a plethora of different commercial lenders, so big lenders, a bunch of alternate lenders, and also private lenders as well. All right, so that's pretty much the same thing. It's just we're able to shop around to see what's out there on the market to give you the best bang for your buck. Whereas when you're working with a mortgage agent or specialist from the bank, said bank that you go to, they're going to only offer you the products that they offer. That's it.
Yeah, a lot more variety.
Exactly, a little more freedom, flexibility, and to pick which one honestly is going to offer you the best service and the best bang for your buck.
Hey guys, so thanks again for tuning in. As mentioned, if you have any questions, don't hesitate to ask. You know how to get a hold of me, and this is how you get a hold of Charles.
Again, thank you for your time, guys. My name is Charles. You can email me at charliekayitaba@gmail.com. Or if you have any questions or anything like that, you can simply shoot me a text or a call even at 905-246-8799. All right, thank you guys.
Thanks guys.
Have a good one.
Bye.